Hey there, you are tuning into Not Another Options Trader, where I am in fact just another options trader, spewing my charts at you and screaming into the void of FinTwit. We're switching up the format a little bit this week, where we're going to first review some of the trades from the prior weeks by looking at the Not Another Options Trader portfolio, and then we're going to talk about this week's likely mistake. With that, let's jump over to the portfolio. So this is the Not Another Options Trader portfolio. We run this on Investopia Simulator, and we start off with $100,000, and it is a game. Currently, we are ranked just shy of 100,000th place out of 118,000 players, and the top person, Christian Senfin, he's at 11.8 million. Good for him. We'll creep up there eventually. So what we're going to do is walk through the trade history here and talk a little bit about what we've done over the past couple of weeks. We already covered UUP, so let's jump over to TLT. TLT was purely a technicals play. So if we take a look at what's been going on with the TLT, we got in here. And the reason is because we saw some support in this area down here, and it gapped higher, and then it shrunk down, and it kind of gapped up again, and it got into this 50% retracement or fib extension pocket off of the lows. And so what is this? What am I actually talking about here? So if you do a 50% retracement from the lows to the highs from October to November, the TLT, the 20-year Treasury bond, it kind of held up right here at the low end of the 61.8% retracement and then jumped up. And so if we do a fib extension from the lows to the highs back to the lows, it gets up into this area, and this is an area of higher volume. And so I decided that, hey, this seems like a good opportunity to get in. I think it's going to continue going higher. We got in here with a $152 call. I bought 100 contracts at $298 for an expenditure of $29,800. I sold on the 6th whenever it was up, and we'll take a look at that chart, but I sold for $380 and I made a total of $38,000. So, that's pretty great. I sold right at the top of this peak here. So that's awesome. All right, next up we have Apple. Why did I buy Apple? So the market kind of crashed and took a dump whenever the Omicron variant was announced, and there could be some other reasons behind why the market took a dump. But if we add a comparison of the S&P 500 to this chart on Apple, what we saw here is that the market was crashing in this area, but Apple was working. It was moving higher, and so I wanted to put my money into something that I guess everyone else felt was safe. And so I took out a $165 call with an expiry at the end of the month here on like the 27th, I believe. And I bought in at $390 for $23,400. And currently it is up $22,800. We have moved from this point. Let's take off the SPY here. We bought in at, like I said, 165, which is right here, and we're trading up in this fib extension range. I think looking at the SPY, we've kind of beaten this fear of Omicron for now, and we have moved back up to the highs. If we take a look at where the next movement of the market could get to, the next measured move based on fib extensions, it's in this 480 to 490 range. And if the S&P 500 is moving there, Apple is moving there too. So let's jump back to Apple. I'm going to hang on to this for a while. I think that it has the potential to break higher. How much higher? That's tough to say. If we do a a little bit of an extension here, 175 to 182. That's what I'm going to say. I'm gonna hold off until it hits to be about 175, 177. We'll see what the date is. As it gets closer to the 27th, I'm going to sell. But I think that we can get up into this range for Apple, and I'm holding until then. So Applied Materials is another trade we put on the 1st. If we jump over to Applied Materials, this was purely a technical play. We can spread this out right here. So what ended up happening is this stock moved, or was in an area of kind of consolidation. Let's zoom out a little bit here so we can take a look and see a little bit better. All right, so it moved off of its lows on October the 22nd and proceeded higher until November 16th, and then gapped down. And then it kind of consolidated in this 147 area until it gapped higher, which is kind of a bullish momentum indicator. And that's the point where I bought in. And it has since, gapped lower and kind of held up along these same ranges and then gapped up again. So right now we're pretty much even. I bought in to Applied Materials with a $150 call. We are beating that right now. And so, yeah, I mean, we're basically kind of holding steady right here. But it has the chance to move up into this 164 to $176 range. And so we'll wait to see if that pans out over the next month. This was a call for the beginning of January. So that is Applied Materials. Target was again something that was kind of a consumer goods focused. I did this as the market was crashing, hoping to maybe get some bounce with people buying into consumer goods, with fear about Omicron. So the market was going down. This is the wrong thing to be looking at. I apologize. Let's go over to Target. Let's add the SPY. Okay, yep. So the market's going down. I got in here when it was crashing, and it has moved up with the market, but it's not necessarily working super well right now. If we remove the S&P 500 from the chart, based on its fib extension off of the lows of October to the highs of November, we have a chance to see the Target stock move from 272 to 288. I'd target to get out in this area, and then while the market was crashing with the S&P 500, I took out a protective put, which I sold pretty quickly after the market bounced. It was a $150 call, or sorry, $150 put. $450 put here, and that's based on the 50% retracement. The SPY held up right along that level and bounced back up, at which point I sold, and it's since gone up. So I lost about $6,000 there. We went from $12,400 to $5,100, but that's just fine. It was a protective put, and that covers all of the trades prior to this week's likely mistake, which is ZNGA. So why ZNGA? Why now? Well, ZNGA has been moving down for quite some time. Let's zoom out a little farther. There we go. So ZNGA saw its highs back in February of 2021, and it has hit its recent lows here in December. If we go all the way out and look at everything, so there's kind of this area of consolidation here that happened from May to February of 2019, May of 2019 to February of 2020, and it bounced in this consolidation area, which makes me feel relatively comfortable that this could be the moment where it reverses. It saw some pretty strong earnings in the last quarter, but with Omicron coming out they are being seen as having some headwinds with people lacking disposable income. However, they did report some very strong earnings, and they've got some new releases coming in the fourth quarter this year. Like I guess Farmville 3 and something Star Wars related. But whenever I think about this stock in general, I'm going home to hang out with my family, and there's just a lot of downtime. And whenever there's downtime, I tend to play games. And if you look over the past couple years, in January, February timeframe, there's always a little bit of a bounce. We see 2017, a little gap higher here. 2019, little gap up here. 2020, look, gap up here. And we're holding steady right here. This is a relatively so I purchased a March 20 or what is it? A March. Where is this call here? A March call where it would allow us to see earnings because they're reporting earnings in February, and the current stock price is $6.29. And I bought a $7 call, and in the portfolio, I bought 200 of these call options at 56 cents. That is not an expensive call option, and so this is, this is a little bit early to be getting in for sure. There's not a great technical setup here with a area of consolidating and building support off of its based on its going down. It has not built a level of support here, but I think that it could bounce, and I'm willing to. This is a little bit more of a Hail Mary shot because it's a relatively inexpensive option. And what's awesome is that if it can do a measured move back up to its highs, which this would be wild if it were to skyrocket back up here. And this is obviously not the right time scale to be hitting it in March, but even if it were to start making its way back up and we were to hit $7, let's take a look at some of the payouts here. If we were to get to $8, that's 180% returns. If it gets to $9, that's let's just say it takes till February. That's 350% returns. Those are pretty solid returns, and I'm willing to take a little bit of a bet on this, to make some money. So this is probably not something for the faint of heart, but it's a play I'm making, and it's fun. You obviously have to size this appropriately for the amount of risk that your portfolio is able to take on, but I am in, and we will see how this shakes out. Currently with the portfolio, we're down $1,000 on it, but we're gonna give it a couple months to see, and hopefully with good earnings in February, we'll see us break past $7. Thank you so much for watching. If you have companies you think I should check out or questions, please leave a comment below. If you like this video, please like and subscribe and hit that bell icon. That way you know whenever a new video goes up. You can follow me on Twitter at NAOptionsTrader. There I post live updates of the trades that I make when they happen, so you can follow along in real time. I am not another options trader, and I'll talk to you soon.